So have you ever pulled up a stock chart, watched the price just violently jerk up and down, and thought, what on earth is actually happening behind the scenes here?
Right, like what is driving this absolute chaos?
Exactly. And more importantly, how does the financial media package that chaos, tie a neat little bow on it, and then sell it to you?
Yeah, that is the really fascinating part.
It is. Because today, we are doing a deep dive into two incredibly contrasting sources. First, we have a company bleeding $500 million that somehow magically doubled its cash.
Which sounds completely impossible on paper.
Right. And to make sense of how you, the investor, hear about this, we got our hands on a leaked TV production playbook. It shows exactly how financial media takes this messy reality and spins it into an AI-generated high-urgency narrative.
It's just a striking disconnect, because on one hand, you have the raw, often very confusing reality of a company's SEC filings.
Yeah, the real number.
Right, the real numbers. And on the other hand, you have this highly polished, heavily legally insulated media narrative that's, basically designed just to keep your eyeballs glued to a screen.
Keep you engaged, keep you clicking. So let's jump right into the raw data first. We are looking at a detailed equity research report on a company called Strive. Ticker is ASST.
ASST, right.
And they have completely abandoned whatever their legacy business model was. I mean, they ripped it down to the studs to undergo this radical transformation into a digital asset treasury. A DETI.
Yes.
Which basically means their primary function, their whole reason for existing now, is just hoarding Bitcoin.
Hoarding is definitely the correct term here. I mean, they're not simply holding a little bit of crypto on the balance sheet for, diversification.
No, not at all.
They have stockpiled 20,246 Bitcoin.
Right.
And that includes a very recent purchase of 79 Bitcoin. They are essentially absorbing as much of the asset as their entire capital structure will allow.
And the market reaction to this is just pure whiplash. The price action on AST is dizzying. If you look over the past 52 weeks, the stock is down almost 78%.
A massive drop.
Right. But then look at the last 26 weeks, it is up 122%.
Yeah, sitting at around $18.22 right now.
Exactly. $18.22. The chart looks like an EKG of someone having a full-blown panic attack.
Well, and that turbulence is the absolute hallmark of a day transition, because the market is aggressively repricing the equity.
Repricing it from a normal company to a crypto proxy.
Right. Investors just no longer care about the operational efficiency of Strive's legacy business. None of that matters anymore. The company is now being traded purely as a proxy for Bitcoin itself.
It makes me think of, well, imagine a traditional struggling cargo ship, right?
Okay, a cargo ship.
Right in the middle of the ocean, the crew just decides to rip out the entire diesel engine, and they replace it with this hyper-volatile crypto nuclear reactor.
That is a great visual.
Right. Because you, as an investor, you are no longer valuing the ship based on how much cargo it carries or how efficient its shipping routes are.
Right. The cargo doesn't matter.
Exactly. You're valuing it based on the sheer explosive energy of the reactor that it is now basically just wrapped around.
Yeah, the traditional cargo logbook gets thrown overboard entirely. And that creates some truly bizarre financial realities when you start actually looking at their balance sheet.
Because the old rules just don't apply anymore.
Exactly. Traditional accounting metrics simply were not designed to measure crypto reactors.
And bizarre is putting it lightly, because I was reading through the source material on this, and the losses they were reporting are staggering. Strive posted a first half 2026 net loss of $523.5 million. Over $500 million just up in smoke in 6 months.
Yeah.
And this is the part that blew my mind. Their trailing 12-month net margin is negative 11,800%.
Let's actually pause on that margin figure for a second.
Please do, because I thought it was a typo.
Right. Everyone thinks it's a typo when they see a number that large. But the reason you get a negative 11,800% margin is just basic math.
Okay, walk me through it.
So net margin is simply profit divided by revenue. But Strive's traditional revenue stream has practically vanished as they pivot to this DAT model.
Right. They aren't selling traditional goods anymore.
Exactly. So when your revenue denominator shrinks down to near zero and your losses from write-downs or operational restructuring are massive, $500 million, the resulting percentage just becomes mathematically absurd.
Because you're dividing a massive loss by practically zero revenue.
Yes. It proves your cargo ship analogy, perfectly traditional business metrics, simply break down here.
Right, okay, that makes sense.
Yeah.
But then look at the other side of ledger. They bleed $500 million, Yet their total assets actually grew to $1.37 billion.
Yep.
And their cash position, their actual cash, more than doubled from the end of 2025 to $145.4 million by mid-2026.
It's wild.
And their total liabilities are negligible, sitting at just under $29 million. So explain this to me. How does a company lose $500 million on paper, but end up with twice as much cash and over $1 billion in assets?
This right here is the core engine of the digital asset treasury strategy. It's a mechanism that we call the capital markets flywheel.
The flywheel.
Right. When a company like Strive transitions to a date, they stop being a traditional business that sells products or services. Their primary business becomes financing.
Wait, financing what?
Themselves. They are selling their own stock.
So the product is just the equity itself.
Exactly. Look really closely at the Q2 numbers in the report. Stockholders' equity only fell by about $68 million in that quarter, even though the company posted a net loss of over $257 million for that exact same period.
So there's a huge gap there.
A massive gap. And arithmetically, there is only one way to plug that. They generated roughly $189 million in offsetting equity credits.
Meaning they issued new stock.
Yes. They are aggressively issuing new shares, selling them to the public, and using that fresh cash to stockpile even more Bitcoin.
Okay, I want to make sure I'm visualizing this flywheel correctly. So they issue new shares, they take the cash from the retail investors, they buy Bitcoin, and they put it on the balance sheet.
Correct.
But doesn't issuing all those millions of new shares destroy the value for the people who already own the stock? Like basic dilution.
Well, it depends entirely on the premium. This whole strategy operates on a razor's edge.
What do you mean by the premium?
So if the market is in a frenzy and values Strive stock at a premium compared to the actual underlying value of the Bitcoin they hold, then the flywheel is accretive.
Accretive meaning every new share issued actually adds more value than it takes away.
Yes. Think of it like this. Say the actual Bitcoin they hold equals $10 per share, but the stock is trading at $15 because of market hype.
Oh.
Strive issues a new share, collects $15 from an investor, and immediately buys $15 worth of Bitcoin.
Oh, I see. So the total Bitcoin per share just went up.
Exactly. The stock goes up further because the treasury grew. They issue more shares at an even higher premium, and the flywheel spins faster and faster, generating massive capital.
But wait, if that flips, if the stock starts trading below the value of the Bitcoin?
Then they are issuing shares at a discount. At that point, they are diluting cheaply, transferring value away from current shareholders just to acquire the asset.
So the flywheel spins in reverse.
It spins in reverse, and it can become a complete death spiral for the stock price.
Okay, wait, hold on a second. I am looking at the balance sheet data from the source right now, and I had to push back on this premium idea.
Okay, what do you see?
Well, I see the massive cash burn. Their operating cash flow was negative $39.4 million for the first half of the year. The fundamentals are bleeding. But the report says the stock is trading at a price-to-book ratio of almost exactly 1.0.
Right, 1.0.
And a ratio of 1.0 means the market is valuing the company exactly at what its balance sheet says it's worth. So, no premium. If there is no premium and they are burning $40 million in cash just to keep the lights on, why aren't investors fleeing? What is the market seeing that the balance sheet is completely missing?
So you are hitting on a massive blind spot in standard financial reporting here. This comes down to GAAP accounting rules versus real-time market pricing.
GAAP accounting.
Right. That price-to-book ratio of 1.0 is a snapshot based on the June 30th, 2026 balance sheet. GAAP rules require the company to record the value of their Bitcoin at that specific frozen moment in time.
Okay, but the crypto market trades 227.
Yeah.
It does not care about June 30th at all.
Exactly. The research report highlights that Bitcoin reportedly surged above $77,000 in mid-August.
Oh, so way after the quarter ended.
Yes. That is a massive appreciation that happened after the books were closed. The Q2 book value is essentially looking in the rearview mirror, heavily understating the actual current value of Strive's treasury.
Right.
So the investors buying the stock today aren't looking at the June 30th snapshot. They are pricing in that real-time mid-August crypto surge.
That makes total sense. They're pricing in the current heat of their reactor, not the logbook from 2 months ago.
Exactly.
And that heat is generating some truly insane trading dynamics. I mean, the report notes an extreme beta of 13.72.
Which is astronomical.
Right, because a beta of 1.0 is just the broader market. So with a beta approaching 14, if the broader market takes a single step, Strive takes a massive leap. And if the market trips, Strive just falls straight off a cliff.
It is hypersensitive to any macro movement. And technically, the momentum is stretched to the absolute limit. The RSI sits at 87.73.
Which is wild. For context, an RSI approaching 88 basically means the rubber band is stretched so tight it should be snapping back. It is deeply, deeply overbought.
Right. In any normal traditional stock, an RSI that high indicates immediate vulnerability to a sudden violent correction.
But this isn't a traditional stock.
No. In the DAT space, these assets can stay irrational longer than most traders can stay solvent. What is keeping that rubber band from snapping right now are the potential structural catalysts looming on the horizon.
Right. The report lists two major ones that the market is watching. First is the speculation about MSCI index eligibility.
Which is a mechanical driver of demand.
How so?
Well, if Strive gets added to an MSCI index, passive funds that track that index are literally forced to buy the stock.
Oh, they don't have a choice.
None. The fund managers don't get to look at the negative 11,800% margin and say, no thanks, this is too risky. The rules of the index dictate they must allocate capital.
So it creates this guaranteed blind source of demand that completely ignores the fundamentals.
Exactly.
And the second catalyst mentioned is a planned White House crypto meeting. And obviously we're looking at this strictly as a macro policy tailwind. Any supportive policy signals from the administration can compress the discount or, extend the premium these DAT equities carry.
It's an environmental factor, yeah.
But here is where the story gets really, really murky for me. Because I found a glaring contradiction in the sources regarding what the insiders at Strive are actually doing.
The discrepancy with the insider buying data.
Yes, it's a massive discrepancy. The research report highlights this news story floating around that claims Strive's board director, Pierre Rochard, bought 15,900 shares in the open market.
Which sounds incredibly bullish.
On the surface, that sounds like the ultimate bullish signal, a director loading up on shares out of his own pocket. But then if you look at the actual FinHub insider data set that was provided in the source material, it shows 0 open market purchase transactions for the company.
Literally 0.
0. How can a news aggregator report 15,900 shares bought while the hard SEC data feed shows literally nothing?
Well, it just goes to show you when a market is moving this fast, driven by algorithms and retail hype, you simply cannot trust a news aggregator or a quick social media headline.
You have to do the digging yourself.
You have to actually read the SEC Form 4 filings.
So where is the news aggregator even getting the number from then? Did they just make it up?
Not intentionally. Often it's a misinterpretation of routine corporate actions. So an insider might be granted shares as part of their standard compensation package, or maybe they are exercising options that were granted years ago at a fraction of the current price.
Okay.
When those transactions are filed, aggregators scrape the metadata blindly and push a headline that says, insider acquires 15,900 shares.
And the market algorithms immediately read the word acquires as a bullish open market buy.
Exactly. But acquiring shares through a zero-cost grant is vastly different from taking your own hard-earned cash and buying the stock at the current market price.
Right. So a retail trader sees the headline, thinks the insiders know a massive catalyst is coming, they smash the buy button, and they are actually trading on completely misinterpreted data.
Precisely. Which brings us to a really fascinating structural question. If the actual SEC filings are this muddy, and the financial aggregators are actively misinterpreting the data, how does the average person trading on their phone on a Tuesday figure any of this out?
Well, they turn to the financial media. And that brings us to the second document we have today, which is honestly one of the most revealing things I've read in a long time.
It really pulls back the curtain.
It does. It is a leaked internal production guide for a financial news show called Market Pulse Daily. And it outlines exactly how the media attempts to package the chaos of a stock like Samdal. Strive into a digestible narrative for the public.
It is essentially a playbook for synthesizing complexity into pure entertainment, all while frantically trying to manage legal liability.
The tone they demand from their hosts is just wild. The guide explicitly instructs them to use a, quote, fast, current, catalyst-driven, constructive tone.
Right, no slowing down.
None. They are told to start immediately with the latest price action. No slow greetings, no nuanced deep dives into negative operating cash flow. It's entirely focused on urgency. What's the catalyst stack? What is the market reaction right now?
The goal is to create an artificial sense of real-time emergency. It keeps you glued to the screen, feeling like you might miss the trade of a lifetime.
Yeah, and the guide literally forces the hosts to pitch a blue sky scenario, like what happens if every catalyst perfectly lines up and then immediately lists 3 things to watch next.
Right, just rapid-fire talking points. But beneath that fast-paced, authoritative delivery, the playbook reveals intense, almost paralyzing compliance anxiety from the network.
Yes, the hosts are acting like race car drivers, but they are strapped into a vehicle made entirely of legal disclaimers.
That's exactly what it is.
The entire show seems built around promoting this AI research tool called StockOracle. The playbook hypes this tool up immensely. It claims StockOracle offers, quote, OracleValue intrinsic estimates, AI moat analysis, and AI-generated bull and bear summaries across 15,700 stocks.
They are basically presenting it as an all-seeing, analytical crystal ball that can magically cut through the noise of complex companies like Strive.
Right, but then you read the mandatory safety rules the hosts have to read on air. They are strictly forbidden from ever giving buy, hold, or sell ratings.
Of course.
They must explicitly disclose that they might earn a commission through an affiliate link for StockOracle. And they have to constantly warn the listener that the AI insights might be completely wrong, that the intrinsic value estimates might be incomplete, and crucially, that the stock data is delayed by 15 minutes.
That 15-minute delay is the most critical detail in the entire guide.
It really is. It's like I'm selling you a high-powered experimental jetpack. I'm hyping up the thrusters, telling you it can take you straight to the moon, showing you all the shiny AI buttons.
Right.
But before I let you put it on, I force you to sign a massive waiver acknowledging that the altimeter is broken, the fuel gauge is delayed by 15 minutes, and oh, by the way, it's not actually meant for flying. It's just an educational tool. If you put that jetpack on a stock like Strive, which has a beta of 13.7, a 15-minute delay is a lifetime.
You are flying completely blind. A 15-minute lag on a stock moving that violently means the difference between a profitable entry and catching a falling knife.
Yeah.
The AI tool might generate a bullish summary based on a momentary price spike, but by the time you hear it on the broadcast and go to execute a trade, the algorithmic selling could have already triggered.
The playbook even dictates the exact words the hosts must use to protect themselves legally. They have to say, remember, it is a research platform, not financial advice. Verify important facts and make your own decisions.
Standard boilerplate.
Right. They literally script the disclaimers to ensure the show is legally insulated while still pushing the affiliate link. It pushes all the risk entirely onto you.
This is why understanding this meta layer of financial media is so vital for you as an investor. When you hear a fast-paced, catalyst-driven update on a complex transition like Strive on TV or online, you have to recognize the structural constraints of the person delivering that news.
Right, their incentives.
Exactly. Their job is not to ensure you make a profitable trade. Their job is to synthesize the data quickly, keep you engaged, pitch the affiliate software, and legally wash their hands of whatever you decide to do with that information.
So they just strip out all the nuance. They aren't going to spend 10 minutes explaining the math behind a negative 11,800% margin or digging into FinHub to prove a news headline about insider buying is actually just a metadata error.
No, they don't have time for that. They are going to use the AI to generate a quick bull case, read the disclaimer as fast as possible, and move to the next ticker.
Because that's the format.
Right. The media package gives the illusion of control and real-time analytical power. But the underlying reality of the market, as we saw with Strive's massive cash burn and their reliance on continuous share dilution, it is precarious, and it demands deep primary source research from the investor.
Yeah. Bringing these two source documents together paints a pretty wild picture of modern finance. I mean, we started by looking at the extreme reality of a corporate pivot. You have Strive bleeding $500 million, practically abandoning traditional business operations just to build a 20,246 Bitcoin treasury.
Yep.
And they are riding a 122% stock surge, driven entirely by a capital markets flywheel and speculation about index inclusion.
It's a company that functions less like a business and honestly more like a financial wrapper for a highly volatile digital asset.
Right. And on the other side, we decoded the media machine, the Market Pulse Daily Playbook, this heavily guarded, legally terrified production that uses AI tools like StockOracle to generate neat little summaries of those chaotic wrappers, all while explicitly telling you that the data might be delayed and the AI might just be totally wrong.
It shows how we are seeing raw assets become increasingly abstract, and the tools used to interpret them are becoming more automated. It's creating multiple layers of distance between the investor and the actual primary source of truth.
It is. Which leaves me with a thought I just can't quite shake, and it's something for you to mull over as you look at your own portfolio this week.
Let's hear it.
If traditional companies like Strive are transforming into nothing more than holding wrappers for digital assets, and everyday investors are increasingly relying on media-packaged AI tools to just summarize those wrappers, what happens to the core concept of a business?
Wow.
Like, are we moving toward a market where companies don't actually make anything or provide a service anymore, and we're all just sitting around trading AI-generated summaries of digital vaults?
It represents a profound shift in how capital flows and how value is perceived in the modern market.
It really does. And it makes you wonder what the next evolution of that stock chart is going to look like. Well, thank you for joining us for this deep dive. Keep questioning the signal, watch out for the noise, and we will catch you on the next conversation.